welcome Dr. Surjit Bhalla, who is session chairperson. He is former executive director of India International Monetary Fund. And all our co-panelists, I would like to welcome, as usual, Dr. Charan Singh. He is very active in this committee and always take the role of panelist, as well as in the absence of session chairperson, he is acting as chairperson also. So Dr. Charan Singh, he is advisor, ASSOCHAM National Council for Banking and Chief Executive EGROW Foundation. So we welcome you, sir. Our other panelists are Sri Madhav Nair, Co-Chairman, ASSOCHAM National Council for Banking and Country Head and CEO, India Bank of Bandhan and Kuwait, BBK. We also welcome Sri Rajan Pental, Co-Chairperson, ASSOCHAM National Council for Banking and Executive Director, Yes Bank. We also welcome Ms. Upasana Bhardwaj, Chief Economist, Kotak Mahindra Bank, Sri Andarnel Sen Gupta, Head of Research, CLSA, India, Sri Abhi Barua, Chief Economist and Executive Vice President, HDFC Bank, Sri Siddharth Sanyal, Chief Economist and Head of Research, Bandhan Bank, Sri Arjun G. Nagarajan, Chief Economist and Communication Manager, Sundaram Asset Management Company Limited, and Sri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM. We all welcome you, all of you, sir. You have taken out your precious time for this seminar. So as we know, today is the Shadow Monetary Policy Committee meeting, discussion on monetary policy. RBI MPC committee members will discuss this monetary policy on 5th June to 7th June. It will be declared on 7th June. So with my initial remarks, I can say the benchmark repo rate should remain as it is, and policy instance also remain as it is. I don't see any change, both of it. My assumption is based on first, we have our India GDP growth at 8.2% in financial year 23-24, and still we are having expectations. RBI has given the expectation of GDP growth in current year. This is financial year 24-25. Last meeting it was given 7%, which is also very good. Moreover, we have seen that RBI has declared dividend, hefty dividend, more than 2 lakh crore. So this is again going to increase our GDP growth in the current year, and our these early indicators, green shoot indicators, are very favorable. We have seen this GST, which is April and May, around 3,81,000 crore, which is in April and May, which is more than 10% from the corresponding period. Moreover, we have seen that Fed Reserve is not of the opinion they will decrease their interest rate in the US, which we were expecting they can reduce by June quarter, but it seems they will reduce by December quarter. So RBI will be cautious in reducing rates. They have to strike the balance between growth and inflation. Our inflation is still their tolerance limit more than 4%. We have seen in April this inflation is 4.8%, and still in May also it is more than 4%. So we are of the opinion RBI will take a very cautious approach and will not reduce interest rate, repo rate in this quarter, or as well as I am expecting they will start reducing rate by 25 basis points in quarter October to December. and one more reduction is we can expect in the last quarter of this financial year. So and moreover, good thing, the government of India has brought back their 100-ton gold from England to domestic world, and we are going to see a very stable government as exit poll telling us. So we can expect a good and long-term stable growth in the economy, and we are going to see the results tomorrow, which may, because various exit polls have shown a comfortable win of NDA more than 350 seats out of 543. So considering all, I am of the opinion we are not seeing any interest rate cut or withdrawal of any change in this policy stance. Thank you very much, ASSOCHAM, for giving me this chance. Over to Dr. Charan Singh. Thank you very much.
Thank you very much, Agrawalji. I think that's from the industry perspective, I think that's very good input that you have given us. And we are going to have industry perspective from even Mr. Madhav Nair and from Rajan Patel. Dr. Surjit Bhalla is in Los Angeles today, and he was telling me he will try his best to connect, but he's just 12.5 hours. So I can't see his name here. So I think he has not joined finally. Okay, it must be 3 a.m. up there now. So the point that he made with me was he thinks there's going to be no change in the stance. There's going to be continuity. So I will treat Surjit Bhalla's comments as that. As far as I am concerned, I think I will now share my thoughts. The EGROW team is here. Indranil Sengupta had to go for a meeting, so he may come back before the end and we'll invite him in. Otherwise, he has given his thoughts with us. Arjun Sengupta has also gone for a meeting and he has given us a lengthy comment. Would like to wait for both of them towards the end. In case they don't come, then I'll share their thoughts with you. Let me place my thoughts with you right now. My own feeling is that, and my analysis is, given the situation, this is the first policy after the election results. So this certainly will not be changing the repo rate or the stance. More so, the economy is doing reasonably well. We have seen the results which have come very recently, just 2 days back, 8.2% growth in 23-24, which is certainly more than what was expected. So it's a very positive sign. In this growth pattern, there are certain pictures, certain concerns also. What we see is that the exports, given the global situation, is taking a hit. Absolutely no doubt. And if you look at imports, imports continue to be rising high. Gross fixed capital formation is in the range of 33.3 to 33.5, obviously aided and supported by the capital expenditure which the government is doing in a big way. If we look at the sectoral increases, there's quite a bit of increase in GDP in manufacturing, 9.9%, which is a very positive sign. And then the construction activity is also 9.9, which is also very, very, very healthy. The financial real estate is growing by 8.4%. So the trend in the sectoral picture is also emerging to be very, very. Now I was looking at how did the growth rate play out during the year. In the first quarter, it was 8.2. In the second quarter, 8.1. In the third quarter, 8.6. In the fourth quarter, 7.8. Then the issue is that would we go beyond 7%? So my own feeling is that what was the earlier projections that the Reserve Bank had made for 2024-25, which was 7.2 in quarter one, 6.8 in quarter two, 7.0 in quarter 3, 6.9 in quarter 4, I think will be surpassed. So my understanding of the data and the way economy is moving is that next year, 24-25, we are certainly going to have a much higher growth rate than projected 7%. Now I say this because if you see the letter which the Prime Minister has released today, I think yesterday evening or today morning, where he speaks that though he has been talking about reform, perform and transform, and he has been talking about speed, scale, scope and standards, he has also spoken that reforms need not only be contained in the economic arena, they need to be far and wide. So therefore, it's obvious that the reform talk is going to become bigger and wider now. In that context, you can imagine that growth, unleashing growth will also be high. So my own reading is when he speaks, when he says that in the next 25 years, I need great contribution and sustainable contribution. Again, welcoming ideas, and there's going to be lots of growth orientation which is going to take place. He mentions about the young demographic India, and therefore I think plans are there in terms of aspirational districts or aspirational blocks and really tapping them. He also speaks in that letter about income equalities and reducing income inequalities. Given that letter and given the exit poll, if things are going to be smooth as has been factored by the market, I expect the markets to do well. I also expect the growth to do very well. Greater impetus should be there. If we look at the sectoral breakup of industry, manufacturing, finding that cement and steel are doing good. As far as financial sector is concerned, bank deposits are doing good. Bank credit is also doing good. IP manufacturing is around 5.5%, which is higher than 4.7 last year. CPI and WPI both seem to be under control now. Both of them have been brought into shape, and that is something very, very positive. Yes, on WPI, our major issue is onion and potato. On potato, as we know, there was a rainfall issue and therefore a problem in the month of January, and that crop has got impacted. As far as onion is concerned, there was, I think, an export ban, and now prices are rising again. These are food prices. But otherwise, if we look at WPI, food and non-food in control. If we look at CPIR policy rate, again, the policy rate as far as overall CPI is concerned is at 4.83%. I think, which is not 4%, that is true, but reasonably close within the range and close to the pivot. The food CPI is a little higher, it's around 8.7. That's a cause of concern that, as I mentioned, this could be for vegetables. So industry is doing well. In the core industry is performing reasonably well if we look at the full year. If we look at IIP, even IIP for the whole year is at 5.8. Last year it was 5.2. And manufacturing there is doing well. Mining is doing well. So very promising. And if we look monthly performance of DIIP in the month of March, again see a positive trend happening there. Annual report of the Reserve Bank has also just been released. The annual report has done an excellent analysis of the global situation in which India is operating and the domestic situation. The picture that emerges there is also that India is on the cusp of a big growth, while the rest of the world is still facing the aftermath of COVID. India has been able to overcome that reasonably fast. The inflationary impact of the war, Russia-Ukraine, and in the Middle East is also ebbing out. If we look at the inflationary pressures in Europe, UK, and America, they're in the range of 2 to 3%. So there is a possibility that there can be a correction in Europe even earlier than what America could be attempting. The foreign exchange reserves in our country are also doing very well. Our import cover is around 11 months now. As far as India is concerned, a very secure economy to mention. As far as the interest rate cycle is concerned, my feeling is American critical cycle, as we know, is getting murkier, but also is getting close to what in November the elections are going to take place. So America may not really go for an interest rate cut immediately. So my feeling is that they will postpone it, and the experts from the market, Abhik is with us, and Siddharth is with us, and Upasana Madam is with us. They will know better how they want to, what they think and what they factor in. My own feeling is in a political cycle, this is going to be a challenge. As far as the fiscal deficit, yeah, but one thing I must mention, amongst the emerging countries, I think Brazil has already done a cut in May. So that way it has set the tone. Whereas advanced countries, all of them, and none of the other emerging countries, major emerging countries, have done a cut. So Brazil has at least done a cut, and all other, like I mentioned, UK may take the lead, that there's a possibility up there. As far as global pressures are concerned, oil prices, as we all know, are around $80, $85 a barrel. But gold price is something to really watch. And if we compare the gold prices per ounce in February 23, as the war started, Russia-Ukraine, it was 1854. And today it is 2327. So gold is reflecting immense uncertainty in the market. India's performance, as you know, we have had recently S&P talking about the NPAs of the banking sector, and they have said that they are very satisfied, they're very happy because they're coming down. Even they have raised our, not much, from BBB minus, that of course continues, but the stance from stable to positive has been raised by S&P. So even that front shows that India's performance is now being hailed across the world. That's why I keep saying that my feeling is that the market is going to improve, the FDI and other flows will improve, and India's performance will also improve. As far as oil prices are concerned, though it's stabilizing around $80 to $85 a barrel, India has been importing significantly large number from Russia. And second supplier, of course, is Iraq. And Saudi Arabia is at number 3. The important thing is the imports from Saudi Arabia are almost 1/4 of that from Russia. So therefore, external sector, export imports, comparing everything, my own feeling is that current account deficit will also come down. Given this overall picture, given the global situation, given America's compulsion, and we having completed the electoral cycle, for next 5 years, we would know where we are. I do not expect any change in the stance or in the repo rate in June. But then I would expect, given the trend, that by August, we would now, and that will be the time between the two cycles, America and India, and I think that will be the right time for India to consider a rate cut. A rate cut is necessary. No doubt, you would argue growth is doing well with a high interest rate. As I mentioned, gross fixed capital formation is high again against the high interest rate. So do I think that the interest rate cut is essential for high growth or investment? My own feeling, as I mentioned in the beginning, we are probably going to grow above 8%, and we have the potential to grow. And if we want to attain that potential, we will have to encourage more investment, and that will only come if we are going to do a rate cut. So this month, I don't expect a rate cut or a change in stance, but I think by August, we should expect. So that is where my views are. With that, I would now like to invite, as per the sequence drawn up by SHM, I would now like to invite Mr. Madhav Nair to share his thoughts with us. He is the co-chairman SHM National Council for Banking and is the CEO India Bank of Bahrain and Mr. Nair.
Thank you, Dr. Charan Singh, and good afternoon to all. I hope I'm audible.
Yes, you are.
Yes, Madhav,
Yeah.
you are.
Thanks. I think both Subhash Agarwal ji and Dr. Charan Singh ji have covered it in length. So in short, I would say that I sort of agree with them on the part that MPC would maintain a status quo basis whatever data is coming in terms of headline inflation being at around 4.8%. Of course, a little bit of worry on the food inflation part. But I'll just sort of digress it a bit. A couple of queries also for the rest of the panel from my side. One, I'm still concerned about the retail asset bubble, which I'm sure my next speaker and my good friend Rajan Petalji may want to answer. I think RBI had increased the risk weight, worried about the unsecured retail loan growth. That's been some time. I really want to see what has happened thereafter. Because if the retail loans are still growing at this rate, maybe that would be a food for thought for RBI to sort of whether to reduce rates or not. That's one point which I would like everyone to sort of dwell on. Because also what I'm noticing from some of the commercial banks, and I had a side talk with Dr. Charan Singh some time back, I noticed some of the PSU banks have been raising rates, and probably in the last two meetings also I raised this. With even recently, State Bank of India raised their interest rates up to 1 year. So I am not sure what kind of a signal is being sent by the PSU banks, who I sort of feel are would be fronting what their thoughts on RBI would be. So possibly if they are increasing rates, a feeling which I get is that probably RBI might not be considering any rate cut, and that's probably the reason why the PSU banks are increasing the short-term deposit rates. The third aspect which I would like to bring to the table is I am seeing a widening between the GDP and GVA, which I also would like the panel of economists to sort of delve on and enlighten what does that mean. So in short, I feel for the time being, I think RBI will maintain status quo. Thank you.
Thank you, Madhavji. That's really interesting. And the assumption that if public sector banks are raising interest rates, what does it really indicate? Okay, let me go on to our next speaker from the industry, and that is Mr. Rajan Pentel. He is the co-chairman, ASSOCHAM National Council on Banking, and executive director, Yes Bank.
Thank you, sir.
Rajanji?
Good afternoon. Am I clearly audible?
Yes, you are.
So good afternoon, Subhashji. Thanks for your great inputs, Dr. Charan, as ever, for great insights, and my dear friend Madhav. And towards the end of my commentary, I would also like to dwell upon what is happening as in my perspective on the retail space and what is actually happening even on the SME. I would like to extend to that as well. But let me first come to the core point. So I would first like to start with my inputs on the monetary policy. The general trend of retail inflation has been towards the side of moderation. Headline CPI at 4.83 YOY in April as against 4.85 YOY in March. Core CPI inflation has been on moderating trend and was recorded at 3.3 YOY in April 2024 against 5.3 YOY in April 23. However, from a monetary policy perspective, it is critical to note that the momentum of increase of food prices was higher in April 24 at 0.7 compared to 0.2 last month. We are also not headed into summer months when seasonal vegetable prices increase. For the month of May, the MTD numbers show an increase in vegetable prices. However, the good part is that increase in vegetable prices is relatively muted against the historical increases. The momentum in the core CPI was higher in April at 0.6 compared to 0.1 in the previous month. Further, the momentum in April was higher than the average for the whole of 24. On the growth front, we estimate India to have grown. What estimate? We actually know that we grew by 8.2 in 24, but we see growth slowing to 7.1 in financial year 25. On the other hand, the GVA for the full year 24 is likely to have averaged around 7, and for 25 we expect it to be around 6.7. So some of these numbers have actually come up. As long as growth recovery holds up, monetary policy focus will remain on keeping inflation pressures contained. The guidance for RBI towards achieving the stated target of 4% should continue. My comments on liquidity. Liquidity conditions have tightened in May 24 with the net LAF deficit averaging to INR 1.4 trillion. Government expenditure has been more moderate with the model code of conduct in place. Meanwhile, tax collections remain very, very strong, resulting in higher government cash surplus and tight liquidity. The RBI dividend of 2.1 trillion would further boost government cash surplus, which was tracking at INR 3.2 trillion as of May 24. Liquidity conditions are likely to ease in H2 of 25 as government expenditure is expected to pick up once the final budget is presented, which is expected to be in July. While it is understood that there can be many exogenous factors that determine the liquidity conditions in the economy, the RBI needs to be guiding the markets towards a neutral liquidity zone of plus minus INR 50,000 crores. This is with the objective of anchoring the overnight rate to the repo rate of 6.5. Now, coming straight on the issue of how the interest rates are moving. While we have seen Fed is going to go slow on the rate increase, but we have seen some signals of increase in the European market. In my expectation, I don't think that India will like to take a decision at its own. I think we will look at Fed, and if we expect them to make any change in the end of H1, India would have some time added to that. So expected changes can happen maybe around the October, November, December kind of quarter, the last quarter of this current year. That would be my expectation. Now, coming on the so some of the things, while our core sectors are doing well, we are going to see good rains. The prediction is that the rains will be better. We have seen a surge in the infrastructure construction, both on the core infrastructure as well as also on the housing sector, both commercial as well as consumption basis. So we have seen a good growth over there. I have one or two concerns, and Dr. Charan, you rightly explained as to how the other factors are conducive of indicating a growth phase for the country vis-a-vis the international markets as well. The concern is in the retail segment. I think the government started talking about around a year back or so. And at that point of time, the first indication came to the banks as a warning that there is a bubble which is getting created. and later on the action on the risk weights. But I think we all the banks, whether private or public, have seen an increase in the delinquency, and that delinquency increase, while with all the policy cuts and all the interventions whichever happen in a cycle have been adequately made. The flow of data from the previous quarters will keep on hitting for a quarter or two, and that is going to remain. But when I do a finer cut on it, and this is where I would also like to hear any comments from the other panel members, is that if you dissect the retail portfolio, and this I'm talking about from an overall industry perspective, when you look at the bureau data and other information, there is a salaried segment and there is a self-employed segment, right? And that includes as an extension the MSME also. MSME is right now holding very, very well. In fact, the repayments in MSME are excellent. The portfolio is absolutely in the pink of the health. But within retail, if you compare salaried and self-employed is showing, I would say a little, there is a sign of stress emerging over there. And in my travel to some of the zones and also a discussion in those zones with the competition, what I find is, and also in interaction with some customers, I think one of the things which MSME sector particularly is talking is that their input cost has gone up, and input cost is both raw material as well as the cost of finance. And now that there is the GST is kind of compulsory factor, and more or less people have understood that they need to comply with the regulations, and they are honestly, to a large extent, I'm not saying the whole of it, to a large extent they are trying to be good citizens and kind of filing their returns, and most of their business has kind of come into the formal sector. Their margins have considerably shrunk, which means that they need more assurance that they will be able to build on volumes, and in case there is any kind of a turbulence, that can have a counter effect on their on not just on their profitability, but some of them say also on their viability. So this is one piece which is which really needs a view as to how the things are going to span out. But coming back to, because most of the money on retail, if you see, actually this funding also goes into business when it comes to self-employed, either for expansion or for investment into their current business. So this is one, I won't say bubble, but this is one concern in a very well-performing portfolio, which is where we are seeing a very low delinquency is brewing up. So this is a concern, right? On the retail side, I think the credit growth on the retail side would be moderate this year, because people have taken measures not only in the policy cuts but also in the pricing, which Madhavji very rightly said. One of the reasons for price increases that the businesses have to be viable, and everybody is pretty now focused on it. So the reason for price increase is nothing but to also take into account the rise in the delinquency. Now, as long as the banks are able to put their act together, I think in the next 1 or 2 quarters, it will, going forward, it will fall in place. But let's not forget that there was an irrational exuberance also. NTC, which is the new to credit customers in products like personal loan, had started accounting for almost 30%. So there, where there was an overconfidence in the market, is getting corrected, and hence the new norms is going to ensure that the coming portfolio is correct. We have also seen, and there are many reports on it, that saving versus consumption, the consumption has gone higher and the saving trends, in fact, for the last couple of years, the saving trends are only declining. While the banks are showing a higher deposit, a decent deposit rate, but the general consumption pattern is looking up vis-a-vis the saving pattern. So that is the second observation. I would love to hear views of other panel members on these observations. Dr. Charan, back to you. Thank you so much for the opportunity to speak.
Thank you very much, Rajan. That's really good. You've given us a set of questions and I thought a good coverage.
Thank you, sir.
I think Indranil has yet not joined. So I would like to now go to Abhi to share his thoughts. We have heard the industry and now inviting members, my colleagues at the Shadow MPC. Mr. Abhi.
Yeah, thanks, Charan, and thank you for inviting me as usual. I am also running short on time because I've just been called for a meeting, so I'll keep this brief. But I just want to I want to just ask a couple of questions. I've been with this, Shadow Monetary Policy Committee for 4 years. I think we tend to agree a bit too much with what the RBI does and says. And in a sense that we tend to be more predictive rather than prescriptive. And I'm glad that Rajan brought in the angle of the margin pressures on MSMEs, the fact that if you have higher rates, you could have adverse selection and get bad customers on the retail side. So I think as an industry body, and a sort of a shadow monetary policy committee, which is essentially being platformed in an industry body, we should be a little more prescriptive and express or communicate our problems rather than just agree with whatever the RBI is doing. I personally think that the obsession with the 4% target is misplaced. I think if we continue to retain our stance and not change rates, at some point it will start to bite. I think in general, we are expecting private investment to take the sort of mantle from public investment, which is likely to suffer because we are likely to see fiscal compression. Even with the exceptional dividend, you will have to cut back on expenditure in some way. So private investment depends on the cost of capital. And I think it is about time that the RBI, laid down a foundation or sort of created a room for pivot where it could go forward and cut rates. And I think our excessive obsession with what the Fed does and the exchange rate is again a sort of misplaced. I think we can, and hopefully with the ECB taking the lead and Brazil having taken the lead already as an emerging market, we are able to sort of get away from the complete fuzziness that the Fed has created, not just through its actions, but also through the various comments that keep coming from different Fed members and creates unnecessary confusion in the market. The last point that last couple of points that I would like to make. I think the RBI's liquidity management needs to be more stable. We keep swinging from temporary periods of liquidity surplus to extremely high liquidity shortages, and then we have these manic VRRs, and that gets replaced by VRRs. I think we need more stability on the liquidity side, and that will keep the cost of deposits and funds down. And I think I see the failure of the buybacks that the government announced as something very unsettling for the market, because the RBI as a banker to the government obviously did sanction and acquiesce to the decision to put these bonds into the market, and they did not succeed at all. So I think on the largely on the fund management side, I think there is much more to be done. And again, I think we are in a, I'm sorry to take a somewhat different view. We are in a monetary policy committee discussion, and let us not conflate or confuse counter-cyclical policy, which is monetary policy, rate changes, etc., with reforms. And I think this is a tendency that I have noticed, that okay, reforms will come, growth, etc. That has a long-term impact. Things will, of course, we have possibly moved to a higher trajectory with higher potential growth, etc. But here we are talking about counter-cyclical policy, namely interest rate and liquidity policy. And my feeling is that the two should be kept together. And given there are enough challenges on the horizon, for example, I think the GDP number exaggerates the extent of growth, and there will be some more deceleration. I think we should press for at least a change in stance in this policy, followed by a rate cut. Thanks.
Blake, I know you have to leave early because you have another meeting lined up, and I think we hardly have a minute or two. Will you be able to take a question, or you have to rush? I know your
No,
meeting
I
starts
can
at
take a
10.
question, and then I held it back for 5 minutes. I can do it for another
Yeah.
5
You know,
minutes.
this questions that was raised by by Rajan as well as Madhav. What would be your thought on this bubble?
No, I think there certainly was overlending in the retail segment. I think there were other players, NBFCs, as well as the fintechs, which kind of incrementally dominated the lending segment. I think these things are best handled through macroprudential measures, risk weights, and so forth. And you can try to rebalance the credit portfolio of banks. Indeed, there has been some rise in delinquencies, but I don't see it as a systemic problem. And if you would see that, fintech lending, etc., has gone down quite considerably post October when the risk weights were raised. And I personally think that, it's a fine line if you keep sort of hiking rates. And but the one thing that I sort of respond to Rajan is that the salaried segment, and especially the salaried segment, which was coming new to banking in a sense, I mean, the IT hirees, etc., that segment has been doing badly simply because hiring has gone down. So that is a problem area. So a lot of the retail loans went into self-employed, and as you hike, this is standard. Maybe I'm getting my economics wrong, and Siddharth and Upasana are there to correct me. But I think if you just keep raising rates, and which is pushed up by policy rates, you tend to attract bad customers. As a standard sort of adverse selection model that one studied. So I think there was a little bit of that happening as well. Yes, but I think this is best handled through macroprudential norms and not by a blunt instrument like the repo rate.
And I think this question that Ventil raised about saving versus consumption, it says savings are rising. And that is one issue. And then the other issue, which I think Madhav raised, that what is the signal we are giving? SBI is raising the interest rates. And I was also surprised. And Madhav and me met recently, and we were wondering, what is this? So what is your thought on SBI and other banks? I haven't followed it up as yet.
No, I completely agree with you, and I think it just I think there's a huge uncertainty premium being built on liquidity availability, and there was a massive because government spending was not coming through because of various things. There was a massive liquidity shortage and so forth, and at that time, SBI and the others hiked their rates. Clearly, the RBI is not, I mean, the RBI, I think, is a little too, obsessed with getting to the last mile, as is the Fed. So maybe that the Fed is setting the template. But given a combination of this periodic liquidity shortages that seem to spin out of control, as well as the fact that that till we keep fretting about vegetable prices, etc., which are largely transitory shocks. But now everything has got sort of factored into the calculation of what the RBI is going to do. I think it's a combination of these two things that led the PSU banks to reprice. I don't think this is necessarily desirable, and I think we should have a better signal and more stability and less uncertainty on liquidity, and perhaps just going back to the good old overnight repo window, and just forgetting about all this complicated mesh of VRRs, VRRRs of different durations, etc. I think is, from whatever I hear from our liquidity desk in our treasury, has just introduced too much complexity, and complexity invariably leads to a rise in risk premiums, and consequently it gets factored into rates. And as you raise rates, you attract bad customers, is the story that I would like to tell.
Thank you. Let's move on to Upasna. Upasna is again from the Shadow Monetary and is a market person. She's the chief economist at Kotak Mahindra. Upasna, the stage is yours.
Yeah, I'm not sure if my video is not working, but am I audible?
Yes, you're clear. Your video, of course, I can't see you, but I can hear you clearly.
Sure. So I'll just go ahead. Good evening, everyone. I just want to take on from where Abhik left in terms of liquidity. I think something very important, while we all talk about monetary policy action in terms of repo rate, yes, that is necessary, and at some point that will, turn, the tide will turn, we will start seeing easing. But I think a bigger tool at this point in time is management of liquidity in the right way. Now, a couple of meetings back, RBI did mention that liquidity stance is different from a policy stance, and they're very clear on that. So the stance that they mention in the policy statement will be more linked to their interest rate stance. But the fact of the matter is, you cannot delink the two. The liquidity and the rates cannot be delinked. Otherwise, it causes a lot of uncertainty. And that uncertainty carries with it a lot of premium, which Avik was also referring to. Now, liquidity, and I totally agree with Avik. I think liquidity has been swinging from one end to another, and that is causing a lot of jitteriness in the market. We started the year slightly better, and by the in the last 1.5 months, we've seen consistent sharp deficit in liquidity conditions. Of course, a lot of this has to do with the fact that government is just not spending. But RBI will have to come out with tools to manage this frictional liquidity not coming into the system. RBI does talk about core liquidity, but the problem is core is basically when they account for the cash balances which are held with the government, but with RBI, government's cash balance with RBI. Now that money, if sustained for too long with RBI, it's not coming to the system. And if it is not with the banking system for too long, then that causes stress on rates. And that's when the fight for liquidity starts, and hence that reflects on rates, the deposit rates, the cost of borrowing, all of that starts getting reflected. And that is what we have seen. So I would say that, monetary policy transmission has to go hand in hand with their liquidity stance, and RBI should focus much more on how to stably provide liquidity. While, of course, we do go back to the February 2020 liquidity framework, which was instated, and we did do away with the overnight repo rate. And now the point is that if we knew that till the election period, government will not be probably in a position to spend adequately, then if not overnight, then RBI should have at least allowed for a much longer window of repo, tenor wise. Of course, they have recently done a 14-day or so, but they could have really gone into
We have lost Upasana. Upasana, are you there?
I'm there. Am I audible?
We lost you for a half a minute.
Am I audible now?
Yes, you are.
Okay. Yeah, so basically, liquidity has to be consistently managed. It cannot be swinging, from one end to the other. And that is something which will bring in much more clarity in terms of stance, policy stance. So I think that is where RBI should focus on largely. Coming back to the repo rate, yes, I think too much fixation about 4% can be done away with. But at this point, we have to also keep in mind that growth is very strong, and it is not just about GDP growth, because GDP growth is little overstated, I would say. But if we even focus on GVA, which is 7.2% for the year last year, that too remains fairly strong. And I mean, there was a question which someone asked about the deviation that is there between GVA and GDP. GDP is largely reflecting the very strong net indirect tax collections. And there itself, it is indirect taxes, which is largely GST, and adjusted for the subsidy payout. So if you would recall, very high subsidy payouts were happening during the pandemic. And from there, we started seeing a significant normalization. That is probably playing up a role in widening this wedge. Uh, our expectation is that from next year onwards, this wedge should narrow. But so that is the reason we focus more on GVA, which gives us a much more clearer picture about sector-wise how performances are happening. And given that GVA growth too is at 7.2% for FY24 and strong, uh, uh, core inflation, if I was to link it to, demand side price pressures, at the moment, core inflation remains fairly benign, but it is expected to go up. And if growth was to remain robust, then the chances are that we do see a core inflation going higher than what we would really be comfortable with. And I think that's the reason probably why, RBI may want to wait a little closer to the last mile before they really act. So I do expect rate cuts to happen, but they would want to wait. And of course, Fed is a secondary variable. Fed actions will be secondary variable. If domestic conditions warrant, then I don't think RBI will wait for Fed's actions. But at this point in time, while inflation is, manageable, not to say that it's too much of a worry, but growth is very robust, and that could pose an upside risk to the core inflation. Also, I want to say that the input prices are rising. It's on a rise, and that too have a potential of putting upside pressure to core inflation going ahead. So higher growth, higher input prices do pose an upside risk to core inflation. So RBI will have to be watchful on that account as well. So I think they can wait for 2 more policies at least before they really take an action. But before that, they need to get their act together on liquidity. Liquidity has to be very well managed. Going into July onwards, I would say, we are expecting liquidity to suddenly turn very ample. So from a tight liquidity, very tight liquidity conditions to suddenly very comfortable liquidity conditions from July onwards. So we'll have to see how RBI can very consistently and coherently manage this part without really disrupting markets. And I think that is going to be the key before they get on to a pivot of monetary easing through rate cuts. Yeah, that's it from my end.
Pasna, thank you very much for even the clarification on GDP versus GVA and your analysis that you think that is going to be from July onwards, the situation could be different. Let me move on now to Siddharth Sanyal. Siddharth, the
Yes,
floor is yours.
thank you very much. Thank you very much, Dr. Singh, and thank you very much to ASSOCHAM and EGROW for this particular opportunity. Always so very enjoyable to come and take part in this particular discussion. Brilliant presentation from my previous speakers, Abhik, Upasana, and everyone else from the industry. A lot of points have already been covered. I'll try to keep it short this time. And the key takeaways, I do tend to agree that possibly in the Indian context, any kind of rate action on the part of RBI seem to be still some time away. Very clearly, we do see that while our inflation forecast for this particular financial year in the vicinity of mid 4%, but risks very clearly, as some of my previous speakers mentioned, is slightly on the higher side. It's true that in the next quarter, we might actually see an inflation print or a few inflation prints even at the sub 4% level. That particular number might actually be, or that particular zone might not actually continue to come in the prints for a very long time, maybe just 2 or 3 prints at the most. But eventually, we do see the numbers moving higher a little more. From the global side, we see more uncertainty with an upside bias in case of a number of items like metals, etc. Food prices had been benign and had been some source of comfort compared to some of the previous years as of now. But given the tendency of frequent weather aberrations or significant weather aberration related events, it's very difficult to have a very optimistic assumption about food prices on a persistent basis. So maybe even if on an overall 12-month horizon basis, even if they are relatively benign, you might obviously a central banker would have to stay prepared for phases of 2-3 months of high food prices all of a sudden. It's in the past, the RBI has demonstrated that they have the degree of conviction in terms of looking through those phases, but now we have to see it in a different context. At that particular point, RBI could say that very boldly because they were considering between a pause and a hike after delivering a decent bit of hike. But now, when there will be a discussion between a pause and a cut, I think the same RBI might actually be slightly more conservative in terms of making their interpretations and making their taking a view on the rate action. Also, of late, as both Avik and Upasana mentioned, and we have seen that there had been quite a bit of easing on the liquidity side, particularly of late by transfer of the large RBI surplus to the government's accounts, and eventually it's expected that sizable surplus will be coming from other PSUs also. So looks like the liquidity side is easing a bit going ahead over the course of the next couple of quarters. And in that kind of a situation, the bar for delivering a cut on the part of RBI will be even higher. Having said that, I'd like to highlight one particular point. My sense is that from the communication of RBI in the recent past, we have seen they kind of highlighted that they are comfortable with the current stance of withdrawal of accommodation. And here, my sense is that the interpretation of the market, interpretation of a lot of stakeholders, as a result, have become a bit tactical, if I may use that particular word, that we do think that the stance will be changed just along with a rate cut or just before the rate cut. But I would like to see the RBI communicating ideally in a slightly more structural and slightly more long-term basis. And I'd put it like this, that we have seen from 2020, during 2022 and 23, we have seen rate hikes. During 2023 and part of 2024, early part of 2024, we have seen liquidity withdrawal. But now we are going through a phase where potentially RBI might be moving sideways on the rates front, anywhere between 1.5 to 2 years from their last rate hike. And on the liquidity side also, they are possibly moving sideways for a while now and might keep moving sideways or rather two ways for a while now. So if they are not taking one particular direction, strong direction on the rate side, they are not taking any strong direction on the liquidity side, rather they are moving either sideways or two-way. if we don't call the monetary policy stance as neutral in this kind of a situation, I think there is a strong case in terms of calling it neutral rather than allowing the market to interpret it very tactically, just as a precursor of delivering a rate cut. If they do move for that kind of a communication, I think that that needs to be communicated well to the market. But there is obviously a case for thinking in that particular line. The other question is to what extent we are dependent on the global factors or US factors. Again, Upasana explained quite nicely that domestic factors will possibly take precedence, no doubt about that. RBI also keeps highlighting that particular aspect. But again, there might be a little bit of extra hesitation on the mind of the central bank in this particular aspect when they are contemplating an easing at some point of time. It was very clear when there was a need for a rate hike, all liquidity withdrawal, the RBI could afford to be a lot more proactive. They started delivering rate hikes, rate action ahead of the global cycle, and that was seen as prudent. At this juncture, given that their rate hikes were not super aggressive, their rate hikes were relatively nuanced, and they are the repo rate at 6.5% is at best, I mean, even at this level, they are lower than the long-term average repo rate. It's not very easy for the central bank to lead or to start delivering rate cuts, given that they possibly be having very few rate cuts in hand ahead of the global cycle. Or in other words, the domestic factors have to be really, really very, very strong. Having said that, one needs to recognize that the growth, without getting into the GDP GVA debate, the growth momentum seemed to be relatively decent. As we discussed earlier, that the inflation number at 4.5 or even slightly higher is decent, but at the same time, there is a little bit of upside risk. And my sense is that this time, the WPI numbers might actually start moving a little higher rather than the way we have seen them in the past year and a half. So it's not very easy for RBI to deliver anything on the rate side. They would have to possibly modulate things a little more proactively or a little more in a consistent fashion on the liquidity side. I completely agree with my previous speakers, and so that's possibly the key things waiting in the policy. My sense is that not only this particular policy, eventually in India, we might not end up seeing a rate cut throughout the calendar year. I do not rule out that possibility now. Also, we do factor in that the credit growth rate might eventually be a slightly softer number during the course of this particular financial year, after outpacing deposit growth rates for more than 2 years now. Most probably we from the 16-17% kind of credit growth number adjusted for the big merger effects and all, most probably we might see 2-3 percentage point lower credit growth number during the course of this particular financial year. My sense is that the offtake or uptick in private capex is still relatively modest and slow and gradual. And there's a bit of pushback on unsecured lending and retail credit. So most probably RBI will not be too unhappy if the credit growth rate is slightly less due to softening in retail lending part. So that's the overall some of the points that I wanted to highlight. Happy to take questions later if there is any. I'll stop here. Thank you.
Siddharth, very strong points, but I totally agree with you on the credit growth. I totally agree. There could be a possibility of a slowdown here. But thanks for very elaborate discussion. Now let me, I don't see Indranil even now here. No, I don't see Indranil here. So let me then read what he has sent to me, so you all would know what his viewpoints are. And even if he joins now, we can then ask him a question or two. So according to Indranil, he is calling for a 25 basis RBI rate cut in October and 100 basis cut by June, assuming that the Fed cuts from November. So that is in the deal. And now let me also read what Arjun has sent me. I don't see Arjun here either. Arjun? No, I don't see Arjun here. So let me read what he has sent. So Arjun says that he continues to see a hawkish pause from the RBI given continued uncertainties globally. The Fed's policy, rupee strength and domestic growth will continue to be the three variables on the RBI's mind. Fed's policy, rupee strength and domestic growth, something which is emerging from our discussion also. On the RBI's mind, that would determine the start of India's rate cut cycle. Core inflation appears to be responding to the RBI's earlier rate hikes, but given domestic strength and no start to the Fed's rate cuts till 25, so he's expecting a rate cut around 25. The RBI would not look to ease rates for most of fiscal 25, with a small probability of a 25-50 basis token cut after the 25 budget. Positive macro narratives have seen an appreciable drop in India's 10-year yield in May. Going forward, with more FI inflows into debt from the JP Morgan bond inclusion, the RBI would buy into this to increase their foreign exchange reserves. This is likely to lead to a situation of comfortable domestic liquidity that is not likely to get entirely sterilized, easing the short end of the yield curve. That is Arjun's input. So with this, I think everyone has made their point. We have exceeded our time. Unless there is a question, I would be happy to close it. I think between the panelists, especially the EGROW shadow members, they have explained the gap between GDP and GDP. And I think they've very well rationalized the arguments that they have made. But I don't know if last minute Upasna, you want to give some view? Or Madhav Nair and Rajan has left, of course.
No, Dr. Charan Singh, I'm good, I think.
You're good?
Yeah.
Madhav?
Nothing from my side too. Nothing from my side.
Nothing from your side. Rajesh, I think we have crossed our time limit, and I know people are in the middle of the first day of the week and a terrific day because tomorrow election results, everybody is running to the drawing boards. So Rajesh, I think it's time we close.
Yes, sir. Now I request Mr. Vasudev Mukherjee to give the formal vote of thanks, sir.
Thank you. This has been very interesting indeed, especially coming shortly after the GDP numbers have been released and just before the new government takes office. So this has been quite an interesting discussion, and rest assured, we'll be putting together all these views together, and we will be sending out our note to the RBI with your views taken into account. So I'd like to thank everybody for being on this call, and we look forward to the next edition of this Shadow Monetary Policy meeting. So thank you everyone.
Thank you so much, sir. Thank you to all.
Thank you. Thank you.
Thank you.